Here's a fact that should keep you up at night. In September 2006, the IMF declared global financial risks were broadly balanced. Just 18 months later, the world's financial system nearly collapsed. The common belief is crises announce themselves, that smart people will spot the cliff before we drive off it. They won't. They never do. The next collapse isn't hiding in a failing bank or crashing stock market. It's buried deep inside the architecture of the financial system itself, in mechanisms so embedded that even the people running it don't fully grasp what they've built. And here's what's truly disturbing. The system has already started breaking. You just can't see it yet. But by the end of this, you will. In 1954, economist Hyman Minsky sat in a Harvard lecture hall listening to Joseph Schumpeter. Schumpeter described how capitalism moves in cycles of creation and destruction. Minsky left with the question, what if stability itself is the danger? It sounds like a paradox. Stability brings jobs, growth, rising markets, and confidence. But Minsky studied cycle after cycle and reached one of economics' most unsettling conclusions, the financial instability hypothesis. Here's how it works. When the economy enjoys long periods of stability, fear fades. When fear fades, people borrow, not recklessly at first, but cautiously and even prudently. A business borrows to expand. Growth covers interest. A bank lends because defaults are low. Investors buy assets because prices have risen steadily, and continued rises seem rational. Everyone behaves sensibly within their environment. Yet beneath the surface, something dangerous builds. Each year of stability makes debt cheaper, lending looser, and collateral requirements lighter. The system shifts from hedge finance, where income covers interest and principal, to speculative finance, where income covers only interest. Then it reaches Ponzi finance, where borrowers need rising asset prices just to stay afloat. No bell rings at the transition. No warning appears. The entire financial system slides from safe to fragile, while everyone celebrates the apparent stability. Minsky died in 1996, largely ignored as a pessimist. Then 2008 arrived, and suddenly every economist cited him. The term Minsky moment entered the dictionary. The point where debt-fueled euphoria flips into panic. Assets are dumped to meet obligations, and the artificial structure collapses. The real lesson wasn't the crash itself, but the dangerous stability that preceded it. Consider the data today. We have just experienced one of the longest artificial stability periods in history. From 2009 to around 2022, interest rates stayed near zero. Global debt surged from $200 trillion to over $315 trillion. By the end of 2025, it had climbed further to a record $348 trillion. That explosion was no coincidence. It was Minsky's hypothesis playing out at global scale for over 15 years. Austrian economist Ludwig von Mises described this as the crack-up boom, a final surge of borrowing and asset inflation that mimics prosperity until it suddenly doesn't. The question isn't whether the Minsky cycle is active. It is. The question is where we stand in it. This brings us to a hidden mechanism few name clearly: the doom loop. In May 1931, a mid-sized Austrian bank called Creditanstalt released a weak balance sheet. Within weeks, runs spread from Austria to Germany to the UK. The Bank of England abandoned the gold standard. Credit markets froze. Trade collapsed. What had been a bad downturn became the Great Depression. One regional bank, connected through sovereign bonds, insurance, and cross-border holdings, triggered a cascade because everything held everything else up. Today's doom loop is larger, more complex, and better hidden. Regulations like Basel III require banks to hold high-quality liquid assets, mainly government bonds such as U.S. Treasuries, European sovereign debt, and Japanese government bonds as buffers. Banks worldwide load up on this safe debt. Your deposits partly fund governments' borrowing. Reverse the loop. Governments face unprecedented debt. The U.S. national debt now exceeds $39 trillion. Japan's debt to GDP surpasses 250%. The U.K. carries burdens not seen since the Napoleonic era. These governments service debt at manageable rates only because banks must buy their bonds, creating artificial demand that suppresses yields. Banks prop up governments. Governments backstop banks. Neither can fail without destroying the other. Add inflation. Central banks raise rates to fight it. Higher rates cause existing low-yield bonds to lose value. Basic bond math. Banks holding these as safe assets suddenly face balance sheet holes. This isn't theory. In March 2023, Silicon Valley Bank collapsed precisely this way. Long-duration treasuries cratered as the Fed hiked rates. When depositors demanded cash, the bank evaporated in days. The Fed and Treasury guaranteed deposits to halt contagion. SVB was no outlier. It illustrated a structural flaw across major institutions. The Bank for International Settlements (BIS) highlighted duration mismatches and large unrealized valuation losses in fixed income portfolios. Losses banks can carry at purchase price under accounting rules rather than market value. Estimates of these hidden holes run from hundreds of billions to over $1 trillion. The doom loop extends further. A third actor has grown massive. Private credit, non-bank lending outside traditional regulation, without deposit insurance or a lender of last resort. In 2015, this market stood at about $500 billion. By early 2026, it has surpassed $2 trillion, driven by the hunt for yield in the zero-rate era. Private credit now dominates lending to mid-market firms, commercial real estate, and leveraged buyouts. When a bank struggles, the Fed can inject liquidity. When a private credit fund falters, it simply stops lending. Companies reliant on refinancing face immediate crisis. Commercial real estate exposes the pressure for $1.5 trillion in debt matures. Much issued at 3% rates matures or refinances amid 7-9 costs. Rental income can't cover it. Defaults accelerate. Those loans sit on bank books, in private funds, and as collateral elsewhere. When collateral weakens, reassessments ripple, tightening credit system-wide. The 1931 credit Anstalt failure started with modest bad loans. Interconnections made it systemic. Today's unknown node could be a private credit freeze, a regional bank failure, or a sovereign restructuring that proves more linked than assumed. The cascade would outpace responses. Ray Dalio's study of empires points to long-term debt cycles lasting 75 to 100 years, far deeper than short business cycles. Debt accumulates, wealth concentrates, the monetary system strains, and reset follows via depression, war, or debasement. The last U.S. cycle ended around 1929 to 1945. Birthing the Bretton Woods Order. Roughly 80 years later, we sit inside the late stage. Symptoms are clear, but the break hasn't come. Policymakers apply short-term patches to long-term fractures, delaying but amplifying the eventual reckoning. A key Dalio indicator is debt service consuming rising shares of income instead of funding productive activity. U.S. interest payments now top $1 trillion annually, exceeding the entire defense budget. This is not politics. It's mathematics signaling late cycle strain. Irving Fisher described the debt deflation spiral in the 1930s. Over-indebted borrowers sell assets. Prices fall, real debt burdens rise. More selling follows, collateral evaporates, and credit seizes. Fisher himself had declared in 1929 that stocks had reached a permanently high plateau just before the crash. Like the IMF in 2006, he extrapolated current stability without seeing accumulated fragility. Today's fragility is visible in the data. U.S. corporate debt has roughly doubled since 2008. An estimated 15-20 of public companies are zombies. Operating income fails to cover interest. They survive only by rolling debt. They embody Minsky's Ponzi stage. High rates kill them. Low rates risk reigniting inflation and tightening the doom loop. Central banks face a trap. Every lever worsens one problem or another. One final element makes this crisis uniquely dangerous. Modern portfolios assume assets move differently. Stocks fall when bonds rise. Gold hedges inflation. Cash protects in slowdowns. The 60/40 portfolio and diversification strategies rest on this. In 2022, that assumption shattered for the first time in decades. Stocks dropped 20, bonds 15 together. Gold offered little shelter. The 60/40ths had its worst year since 1932. Every major class fell in unison. Why? Cheap central bank money inflated all assets simultaneously. They rose on the same tide. They fall together when it recedes. Academics call this correlation convergence. In a systemic shock, diversification vanishes, everything moves downward at once. The 2022 episode was a warning under managed conditions. An untelegraphed shock from an obscure corner, a private credit fund halting withdrawals. A Japanese regional failure or unexpected sovereign stress could cascade faster than institutions can react. The Fed's response room has narrowed. Aggressive cuts risk inflation and the doom loop. Holding rates risks zombie failures and balance sheet erosion. The 2008 toolkit zero rates and massive printing starts from a worse position today with higher debt loads. Economists like Nouriel Roubini warn of a stagflationary debt crisis, high inflation, high debt, and low growth colliding, each blocking normal fixes. Michael Burry has flagged passive index funds, which channel trillions proportionally across stocks, creating concentrated risk disguised as diversification. In panic, selling hits everything at scale. We are here. The Minsky stability trap has run for years. The bank's sovereign private credit doom loop has grown too big for easy backstops. Dalio's long-term debt cycle displays late-stage signs. Diversification, long relied upon, may fail precisely when needed most. The crisis won't announce itself. It will start in some overlooked market corner. By the time headlines hit, the window to act may have closed. History shows survivors weren't those predicting exact timing, no one can, but those who understood the architecture, which pieces were load-bearing and which moves would shift everything. You now see those pieces. The ancient Romans watched their silver coins lighten over a century, adjusting to the new normal until they forgot true silver. Don't forget what real stability looks like. History isn't just the past. It's a live diagnosis of the present. Right now, the patient shows clear fever. The thermometer has been ignored for too long.